So good morning to you. And yesterday we had some discussion about the two components of operating return on equity. And the numerator was the operating profit, and the denominator was the shareholders' equity. So we try to do some calculations now with the real case company, British Petroleum. And you can see here that we have the operating profit for 3 years, and I can quickly write down operating profit, and maybe I should zoom in so that you can see it clearly. And here we have 3 years. We have 21 the previous year and another previous year. And here we see that the operating profit is 18,082. So I'm just writing down 18,082. And then in the previous year, it was a loss, and the loss was because it's in brackets, in parentheses, and it's 21740. So what I do, I put minus sign first, 21740. But in 2019, when COVID didn't strike, the profit was 11,706. So 11,706. Yeah, 2019, sorry. And then we have the denominator, which is the shareholders' equity, and the synonyms of shareholders' equity is just total equity or net assets or even net worth. So depending upon the company you choose, you might, but I think the equity is the most common expression. The rest terms are just for your knowledge. But for this purpose, we need to go to the balance sheet, the group balance sheet or consolidated balance sheet. And we don't need to do any calculation. We know for sure this calculation is done already. Total assets minus total liabilities is 90439. Don't ask me why, but it's a kind of norm. It's not a rule, but a norm that income statements are often showed for 3 years, but the balance sheet is shown for 2 years, right? And if you want to find the previous years, because you are going to do the calculation for 5 years, it means that you need to see when if you want to get the data of 21, by default, you will get the data for 2020 as well, right? But if you want to get the 19 and 18, then you need to see in the archives of the company, or just simply Google 2019 report, right? Then you see 2019 and 18. And if you want to add 17 and 16 as well, then you need to go to the 2017's report, right? You see my point? So there is always 2 years. So one report covers 2 years. Income statement covers 3 years, but the balance sheet covers 2 years. So we have to see the minimum common denominator, which is 2, right? Total equity is 90439. First of all, I write it 90439. 439, and the total equity here is 85568. 85568. So let's not take 2019 then, because I have to go to another report, and let's call it total equity. Total equity, all right, or net worth or net assets. And here now we can calculate operating return on equity. So it's quite simple. Now we need to simply have a numerator and a denominator. And if I want to show them in percentage form, or no, then I need to format, sorry. And if I need to show them in the percentage format, then it comes to be like this. And yeah, so you can see that the company, right, understandably had very bad performance. They have 25% loss on their equity, but in 21 they recouped, they recovered very well in 2021. And I would say that 19.99% of profit is really good. You know, I mean, this is really good. Double-digit operating return on equity is really cool. But don't forget one thing, that in Moodle, in the study material, there's one folder called spreadsheets. And in the spreadsheets, I have done BP's calculations comprehensively. Basically, everything that you require for your assignment 1 has been done there, right? I will come back to that stage, but I just want to show you one by one here so that we are on the same page. The reasoning of operating profit, I think we discussed yesterday, that if you want to invest in some company, you don't want to invest on the how much interest they earn or how much tax deductions they get from the tax man, but basically you want to see how much has been their operational performance. If I want to invest in Apple, I don't want to see their bank account. All I want to see is that how much their operations have been successful. The software they launch, the phone they launch, has it been success? Okay, so that is why many people, if they want to see very deep down analysis, very specific analysis, they prefer operating profit rather than net profit. But of course, net profit has its own relevance. We have one more ratio called return on capital employed. The return on capital employed is based on the philosophy that, you know what, there is nothing wrong with the return on equity, but you are only checking the performance based on the shareholders' equity. Equity is one form of financing, but it's not everything. We have another form of financing also. And another form of financing is called debt capital. So therefore, if you really want to see the company's performance based on the investor's money, then you are missing something in this ratio. And that missing part is debt capital, finance capital, how much you borrow, right? So therefore, this is conceptually an improvement over the previous ratio. So we call it, nothing changes. Your numerator is still operating profit, and your denominator is total capital employed, which includes what? Which includes the debt. Yeah. So therefore, yeah. So we include the debt. And where is debt? To get the debt, wait just a sec, I want to double check. Yeah, that's fine. So where would you get the debt? Liabilities. Look, you will see that there is a phrase called finance debt here. And there's a finance debt here as well. First of all, should we include all liabilities, or should we only focus on the finance debt? When you say debt and equity, so we have liabilities, we have debt. What should we take? Liabilities or debt? Debt, yeah. The reason is that debt is a liability, right? But not every liability a debt. But here we only focus on the debt. And debt has many expressions, many phrases. I can tell you that what type of phrases you'll be seeing when it comes to debt. Did I mention it in the slides? Let me check. If not, then I would show it. Debt has many other names. The one name debt has is, and now please make sure that I'm trying to add to your vocabulary. Debt can be just debt, or we call it finance debt, or we also call them borrowings, or we also call them as interest bearing liabilities, or we call them loans as well. These are the various terms, or maybe some other terms which I have not taken into account. These are the phrases that we often use to denote the finance debt that we need, the debt capital, okay? So debt, just debt, finance debt, borrowings, loans, or sometimes we call them as interest-bearing liabilities. And why we call them interest-bearing liabilities is that, try to understand, if I borrow money from the bank or an individual or anybody, I pay interest. I'm supposed to pay interest, right? So that liability is an interest-bearing liability, right? But if I buy some raw material from a supplier and I agree to pay my supplier for 3 months, in 3 months, I will not pay interest to supplier for 3 months, because that's more like an operational arrangement. It's a part of the business practices. So it's a practical thing rather than lending or borrowing. You see my point? So therefore, you don't pay interest to supplier. The money you owe to supplier, as you said yesterday, is a payable, right? You never pay interest on payables. But if I borrow for 3 months from the bank or anybody, I would pay interest. So there's a difference between liabilities. One are non-interest bearing liabilities, like the money you owe to supplier, but the money you owe to the bank and you have to pay interest on top of that. Yeah. So therefore, we only take into account the interest bearing liabilities. And one more conceptual thing, which is very vital to understand now, that you notice now in BP, finance debt is appearing 2 times. One in the current liabilities, and the other is non-current liabilities. And what is the benchmark? What is the bottom line? What is the difference between the current and non-current? 364 days. Now, it may sound a little bit controversial, or it may invoke many questions. When we talk about the finance debt, we only take the non-current finance debt. We don't include, for the calculation purpose, the current finance debt. The reasoning behind the exclusion of the current finance debt is that, because why you have capital, why you have equity, why you have debt? Because you want to do some expansion, you want to invest in the company. And the idea is that what type of investment, because this is a very short period, 364 days, a very short period, and the finance debt is only used to pay your day-to-day operational issues. But you can't really make a big, massive $1 million investment, because you have to return this money within the span of 1 year. Whereas the non-current finance debt, it could be for 1 year, it could be for 5 years, it could be even for 20, 30, 40 years. So the time window is larger to repay. Therefore, you have more time to take big strategic investment in the company. Whereas in the finance debt for the current period, you have to return the money, in a span of a year. So therefore, you can't really rely this current finance debt to make massive investments in the company. This is why we have a reasoning that often we exclude the current finance debt from the calculation of total capital. And we only focus on the equity. Equity is permanent, it's eternal. You sell shares, somebody buys shares. Debt is something which has a fixed life. So therefore, we do not include the current finance debt in the phrase debt capital. Have you understood the idea, or you want more discussion, or you have some questions about it? It's a very big thing you need to remember, that the rationale of not including the current finance debt is that you have to return this money fast, soon. Therefore, this money you can't really use for big investments. It's more like, okay, you have some debt and this month sales is not very impressive. You have to pay, still you have to pay to suppliers, still you have to pay to your staff, still you have to pay the utility bills. That money, which is part of finance debt for the current period, this money you can use to pay towards your short-term liabilities. But you can't really make big R&D project with that. You can't really do a big product mix. You can't really invest in a new subsidiary in other country because time is too short to pay back. This is why we do not include the current finance debt in the phrase debt capital. We only take the non-current finance debt, or whatever the words are used, borrowings, interest-bearing liabilities, or loans. Right? Sometime one word which comes to my mind, which is another word you might come across, that is called finance lease. So finance lease can be one more word add to your vocabulary, which basically is the finance debt. Finance lease. You take the money on lease, basically. Like you take the building on lease and you see my point? You take an apartment on lease, you pay back. Same way, you take money on lease, you pay back. So when your contract is over, you give the apartment back to the landlord, and you also pay, you make sure that by the time when you leave the apartment, finally, you have paid all the outstanding rent as well. Same way, you take finance on lease, money, use it, no problem. But at the end of the contract period, give the money back and also make sure that you pay interest back to the lender, right? So this is why we can also use the phrase finance lease. That's one more word you can add in your vocabulary. But remember that as a logic, as a rationale, we only take the non-current component of finance debt, right? Okay, all right. Now we go back to the British Petroleum, and we find that the finance debt is 5.5. Remember, look, can you see here? There is a current liability and there's a finance debt, but this is for the short period. I don't take it. This debt is more to support your day-on-day basis activities, operational activities. But for the strategic activities, we need to go back down and see the non-current liabilities, and there is a finance debt here, which is 55619. So I can call it finance debt, which is 55619, I guess. And the other one is 63305. 63305. This is the debt cap. Now, I would make a calculation called total capital employed, or just total capital, no problem. And this would be total equity and total finance debt. So I need to sum up, I need to add this plus the finance debt and then extend the formula here. And now I can calculate operating return on capital. On capital. The denominator is bigger now, so obviously the performance indicator would be smaller than operating return on equity, because now the numerator is same, but the denominator is now bigger. So the percentage would go down, but of course, we are aware of this thing. So operating profit divided by the total capital employed. And here we go. And if we, the formatting and percentage, there we go. So this is the operating return on total capital employed. And as you can see that for the same year, this is big and this is small for the obvious reason, because this does not include debt. This does include debt in the denominator, in the base. So obviously the resultant number would be smaller. Make sense? Are you clear about this thought that we only take the non-current finance debt? Okay. Yeah. All right. Now we go to the next ratio. I will not go too much into the theory, because look, my way of writing the slide is that I don't give the bullet points, because then you'll be confused what this bullet point stand for unless I have the recordings. But I try to give some kind of sentence form slide so that you can read the full idea what I want to say. But that doesn't mean that I would be reading everything. Another ratio is called the asset turnover ratio. The asset turnover ratio. The asset turnover ratio basically tells you how many times you have to generate the profit that you cover the cost of your assets. For example, you invested 100 euros. These are your assets. And you earn the profit, revenue, sorry, the revenue, total revenue, not the profit, but the total revenue is 100 in the first year. How many times you have to earn the revenue to cover your cost of investment? I repeat, you have invested 100 euros, and when you made the investment of 100 euros, your total revenue in that period was also 100 euros. So how many times you have to generate the revenue to cover the cost of your assets investment? One time. But imagine you invest 100 euros and you earn 50 and 50. So, okay, forget it. Only focus on 1 year. This is 23. You have made an investment of 100 euros, and at the end of the year, you have a profit of 50. Revenue of 50. Revenue 50, assets 100. 50 divided by 100 is what? 1/2. It means that you have to generate profit at least 2 times to cover the cost of the investment in assets. Which project is better? The one which cover the cost faster, or which cover the cost in the longer period? Apparently, of course, we use the phrase in business world, ceteris paribus, the other things being equal. But apparently, which one you like? Do you want to cover the cost quicker, faster, or do you want to cover the cost of your investment in the longer period? Which is more efficient operationally? The faster, yeah. Because there are many investments where You make the investment in the intangibles, or the technology is changing very fast. Like in the media world, I have a friend, he makes movies in India, and we had discussion about it, that why you guys charge so much money, even though this all camera and stuff, comparison what you get from the people who give you this, who assign you this job, they pay you a lot of money. Even though I know the cost of camera and stuff is very high, but still you take too much money. And that's what he said, that in our field, the speed of obsolescence, technology getting obsolete is very fast. So therefore, we make big amount of investment in buying the new cameras, but we have to earn fast so that we are covering our cost, we reach the break-even point, and then we also make money out of it. And then after 2 years, when this camera will become just antique, I'll keep it away, or maybe a sell to somebody, and then I have no choice, but I have to buy a better quality camera if I want to remain in the business. Otherwise, nobody would assign me any job. So that is why I want to earn more revenue from the people who give me job. So in the IT companies, even in the tangible assets, not all assets, but the many assets, tangible ones, where the speed of the technology getting obsolete is very fast. Like in textile companies, in sugar companies, in furniture companies, the speed of obsolescence is not so fast. But in the automobile sector, the speed of obsolescence is very fast, even though both are tangible assets-based companies. Right. So this is something which is a good company performance, but to be honest, I must make a confession that this indicator is not used so often. The idea is that you are using not profit, but the revenue. But I think, so it's not showing one part of the story, and that part of the story is that it is not showing the cost side. It could be that it only shows how quickly, how fast you are able to reach the break-even point, okay, which is fine, right? But it's not something which investors use more than this formula or the previous formula. It's a one indicator, but not the most favorite indicator, right? So in the health check, we included, and we also want to see that we want to see that how fast. But again, there's a one problem. And there's a one big philosophical problem with this formula. Not just numbers, but the interpretation and the inferences. If this indicator become very popular among the corporate leaders, there's a danger that the corporate leadership would become myopic, short-sighted. They will shy away from investing in the long-term growth-based assets. So they will not be too much concerned about the longevity of the company, but they want the quick bucks from the company. So the mindset would become very short-sighted. And then many times, when on the one hand, the investor, the company leadership, the board of directors have a choice to make the fast money, even though this doesn't add to the company's enterprise value, it doesn't increase the company's reputation, it doesn't enhance the longevity of the company, they would still use that short-term indicator. On the other hand, it could be possible that the investment is big amount, the denominator is much bigger, investment in total assets, but for the first few years, the revenue would be very less, or rather losses, maybe. The revenue is too bad. But in the long term, that would be really good for the company's growth, sustainability, and its further development. You see my point? So then, if people become too much obsessed with this formula, this indicator, this performance measure, then they would rather sacrifice long-term growth in favor of short-term growth. And already, I tell you something, companies all over the world, CEOs all over the world are under pressure of investors to produce the short-term results. So the long-term growth perspective is already in danger. And if we adopt this measure, this will also put extra pressure on the CEOs to generate faster, replication of the assets value through revenue. And this would put extra pressure on them. I tell you something, there was a survey some 10 years ago, and that survey is still valid. There was a survey in which 100 CEOs / CFOs, Chief Financial Officer, of the top company in Forbes 500 list were face-to-face interviewed. And this is 10 years ago, and I think things have become even worse than what they were 10 years ago. And they were asked one question in the interview. Do you believe in the short-term growth perspective of the company or the long-term growth perspective of the company? 75% said we believe in the short-term perspective. And I'm not talking about this small-time startups. I'm talking about those whopping big-size company in the US. I mean, if there are 100 top US companies in the Forbes 500, so most of them would be from USA, I can bet you. What does it show? And then the follow-on question was that, why are you short-termist? And the answer was that we have so much pressure from the investors, from the institutional investors, the big banks who invest in a company, the big hedge funds who invest in a company, the big private equity investors who invest in a company. They put us so much under like a pressure cooker situation that we, let alone long term, if we are falling short of targets on quarterly performance, quarterly means after every 3 months, they really threaten us that they would shift their investment from this company to that company. So we have no choice. We are under huge pressure to generate a very good looking short-term performance indicators. Even for while doing it, even if we have to sacrifice the company's long-term growth, we will do it because we have no choice. And I tell you something, in Europe, things are even worse than America. You know why? Because in the US, the investors are more individual investors. So there's the institutional investors are lesser. Whereas in the continent Europe, the investment is very condensed. You might be having one family which owns about 75% of the company. Or in some countries like in Finland, or in the state is owning about 80% of the company. So the investment is very condensed. But state doesn't ask you to produce profit. That's a different thing. But if that ownership, like in Italy, for example, Southern Europe, French companies, the families own a massive part of the company's equity. The ownership is very condensed. Or the banks in Germany, for example, the German banks are so big, they are investing. They not only give you loan, but they also invest in the equity of the companies. And they put more pressure on the CEOs to generate performance faster. Why? So that they get more money from the investment, and then they can show to their own investors, look what we have done in the short span of time. You see my point? So the banks, they want to please their own investors by putting more pressure on the companies in which they invest. And my worry is that if we become too much reliant on this ratio, then every CEO would like to have the denominator smaller, because how can you increase the ratio? Same denominator, higher numerator, or same numerator, smaller denominator. So therefore, it's possible that the CEOs would be under more pressure to have less investment, and because they want to give a good indicator that way. See the point? So there is a big corporate governance problem. There can be a big, there's a possibility of manipulation. There's a possibility that you are playing with the numbers. The reasoning is to produce good numbers in the cookie jar, but you are not concerned about the company's future, really. That's the idea. So therefore, I don't like this too much. That's why I wrote here that be very careful, take it with a pinch of salt. Corporates can do some manipulations by showing very handsome looking asset turnover ratio. Do you want me to calculate this? Because you have the revenue, you have the total assets. Revenue is in the income statement and the total assets are in the balance sheet. But we can do it, no problem. So here, we need two more indicators, total revenue. I'll make sure that I don't forget this spreadsheet. I save it somewhere. Total revenue and total assets, okay? The total revenue is here. Let's see first total assets. Total assets are 287,272. 287,272. 267,654. 267,654. And the total revenue is the total revenue of the company is here. We need to go to the income statement. The total revenue is 164,195. 164,195 and 109,078. 109,078. Okay, and this is your and this shows that okay, this come from income statement, this come from balance sheet, and basically it matches the number of times the $1 of assets generate the revenue. So more the merrier. So how many times you generate the revenue from the same investment. Higher the ratio, good it is, because it shows that how many times you are able to generate the revenue. So the asset turnover ratio is basically, we have a numerator and then we have a denominator. Okay. All right. So obviously, 21 is better than 2020 because here the asset turnover ratio is higher. So it shows that $1 or €1 of investment is showing, is creating revenue 0.57 times, and the other investment is creating the revenue 0.40 times. So this revenue covers almost 57% of your investment cost, and this revenue covers about 40 point. So this revenue would fast covering your cost of investment. I would be more angry if this number is showing this and this, so they don't change. But what happened that this number is smaller than this number. See my point? If this number was smaller and this number was bigger and the final result was still the same, then I have a reason to be a little bit angry with this. Then I would say, you know what, exactly, I was doubting, I was suspecting that they would do this manipulation, and they have done it. But I would still say that this ratio should be used with very caution, see the longevity of the company, sustainability of the company, the long-term growth. I think the long-term growth is very, very, very important. If you're CEO of a company, if you're top executive of the company, then you should be more concerned about the long-term growth, not the short-term things. You know, company is a long-term entity, so you can't play with its future. All right, any question? So we are also studying the corporate governance along with, why corporate governance? Because basically it's managerial accounting. So there are executives sitting there in the board of directors, which also have the non-executive directors. So you have to show these numbers to influence them. But are you influencing them genuinely, or are you playing with the numbers and just because you know accounting more, so you can basically fox the people? So this way. All right, we take a short break, maybe 2 minutes, 2-3 minutes, and then why I'm taking short break, because this formula 4, 5, and 6 is a little bit different from, but it's again about operation, but so we can refresh ourselves. So let's take a short, very quick short break of 5 minutes, maybe. Okay, so the next ratio we have is inventory turnover ratio. It shows that the number of times you can change your inventory to the sales. The inventory turnover ratio, let's see this way. You have the inventory in the stock. And why you have them? Because you want to change them. You want to convert the inventory to the final output. So the idea is that how many times your inventory gets changed, converted to the final production of goods and services. We prefer that inventory comes and becomes the final output faster, more number of times. I mean, you would like to have your inventory coming fast and getting processed and becoming the output fast, rather than you buy the inventory in January and it's used not before September. It means that there's a lot of cost. There is a space cost, there's a maintenance cost of the inventory because it's not being used. So you have to hire more people, storekeepers, who are taking care of the inventory rather than processing it. I, being the investor or being the manager of the company, factory, for example, I would like to pay more wages to my factory workers who are processing the inventory to the output, rather than hiring more storekeepers who are just taking care of the inventory's stash in the stock. See my point? So this is why we prefer that a higher inventory ratio, better it is. So this is also showing the factory floor level operating efficiency of the company. And how do we calculate it? We just have the cost of goods sold, and then we have the total inventory. And if this ratio is increasing, it shows that we are processing the inventory faster. You know, this way we work out. And what do we need? We need the cost of goods sold, and we also need the total inventory. Now, to get the cost of goods sold, you might, so if I say COGS, cost of goods sold, is there any way, I'm giving you a puzzle, and I can calculate cost of goods sold without seeing the income statement? Is there any technique I can use that I can find the cost of goods sold without looking at the income statement? Well, I can go and check from the income statement, no problem. You minus what? No, assets, you have to go to the balance sheet. Look, okay, I give you some more time, I think. Sorry?
Operating return on capital.
But that's in percentage. I want the figures in million, let's say $1 million, for example, the absolute figure before I calculate the ratio. Sorry? No. Revenue is in the income statement, equity is in the balance sheet. Any ideas? How do you calculate operating profit? It's total revenue minus cost of goods sold. So now, if I have total revenue, and I minus operating profit, I will have the cost of goods sold, won't I? And now, if you want to double check, you can check that all these costs here, 92923, 2584313, you sum them up, it would be 146113. If you want to, if you enter an aircraft, it's like a jumbo, it's like a Boeing 737, Helsinki, New York, and there are 600 seats. And your job is to calculate how many passengers have occupied the seats. What is the fastest way of checking? No, that's not, because then nobody would give you this job, because somebody say, hey, go and check how many people are sitting without any referring to the data. No paperwork. You are in the aircraft empty-handed, no data. You're sitting in the aircraft and you're told, hey, you sit here, stand here, see there are aisle right this way, 3, 4, 3, 10 people in one row, 600 capacity. There are passengers sitting about to take off the plane. Count, we don't have any piece of paper. Count how many people are sitting here. You can count the head count, just go with the head count, or you can see the number of empty seats and subtract from 600. Isn't? Yeah, but you want to, what takes longer? Number of people sitting or number of seats vacant? Depending upon, it could be that the flight is empty, then only see the head count. Let's say 10 people are sitting in the capacity of 600 capacity aircraft, then count 10 people. But if there's you see that there's a huge crowd of people, but some in between the seats are vacant, just go and count the seats which are vacant and subtract from 600. Same thing we have done here. So we just took the total revenue and then we minus the operating profit, and that gives us the cost of goods sold, rather than counting and adding each component of cost of goods sold. Because see, the cost of goods sold, the total is not given. So you have to add up each item. Well, you can do this way, no problem, if you want to. And now the next thing, we need inventory. And inventory is an asset. And if it is an asset, it has to be in the balance sheet. And it will be most likely, I think we discussed yesterday, most likely, I think I have rarely seen inventory in the non-current assets, because generally you buy inventory and process within a year. If you see the current assets, yeah, the inventory is here. 23711. 23711, and here we have 16873. 16873, and the formula is that we have the inventory turnover ratio. I can use the abbreviation. And this was cost of goods sold divided by the inventory. And then, so nearly. So I think the inventory turnover ratio shows a little bit of inefficiency. Last year, the inventory was modified into the final output 7.7 times. But this year, in the recent year, this is processed only 6.16 times. So there is some operational issues with the companies to inventory management. Probably for the same amount of production, they have too much of inventory. So probably they can reduce their inventory. I mean, they have more inventory than what they need, basically. That can be also. So after saying, well, you never know, you only know in retrospection. And now because you know, you can make the better inventory plan for the next year. So I think the inventory should be based on the demand forecast, something to do with that. And if there's a revenue, average revenue is growing at certain percentage. So I think the inventory should also be placed in relation to that, so that you don't end up having too much or too less inventory. Make sense? And then, very interesting ratio is called inventory days in hand. Means, if you are a company based on the factory production and you need raw material on everyday basis, is it a wise idea to buy the raw material every day in the morning, and then you bring to the factory, and then it's processed, you produce, and next day again you buy it? Well, in some cases you have to, like for example, if you're in the restaurant business, you have to buy the vegetables and things like that in the morning. You know, you want to buy the fresh, especially if your restaurant business is a small scale eatery type of thing rather than a full-fledged restaurant. Then you might have to buy, because you don't have enough storage capacity and you don't have the refrigeration things. So you are required to buy certain ingredients every morning, and so that you use it. But in many cases, it doesn't happen. So basically, it could happen that you are in the furniture manufacturing business, and from experience, you know that on a given day, in your warehouse, there should be enough raw material for the next 60 days. And then you check every day how much inventory has been consumed. And when it hits certain minimum level, you order the fresh order. You have the fresh booking of your raw material. You see my point? So you want to see, in this case, for how many days BP should maintain its inventory. It's quite simple. You divide 365 days by the inventory turnover ratio. And inventory turnover ratio, you have done it already, right? So what we do here, you just divide, so okay, inventory days in hand. Inventory days in hand. Tell me something. Are more days a better indicator or a worse indicator? Last year,
Worse.
Worse. Why so?
Because it shows that the total maybe
Yeah, because you're right. I mean, more number of days inventory you have to maintain, basically put extra pressure on your resources. First of all, you need to have more space because you have to store it for longer days, and that adds to the rent. And the second thing is that your your money is stuck, basically, your capital is stuck. So now you have to make an arrangement with a supplier that he gives you more number of days inventory. So you have a bigger order and you have to pay more. So you keep the money reserved because after 3 months you have to pay. Look, when you pay him after 3 months, it doesn't mean that you just go and borrow, get the money from the bank and just transfer it. You have to prepare yourself to meet your liability even now, though you pay him after 3 months. So then you have to prepare yourself for more number of times, you see? So there is an extra pressure on the middle level managers to make sure that they maintain the inventory for longer days. So that's not a good sign. You're right, actually, that this is not a very promising sign. So what I do here, so we divide 365 by the inventory turnover ratio. Yeah, that's a bad sign. In 2019, 20, right? BP was supposed to require its raw material, or let's say inventory, for the next 47 days of their operation. So at any point of time, there should be enough raw material or the other inventory components in the warehouse for the next 47 days. But now they have to maintain for the 59 days. So this also shows some kind of operational inefficiency, right? That there is something wrong going on in their storekeeping department. I mean, they're not keeping, either they are not consulting with the sales department, or it could be that the sales department is not giving them the proper information, or maybe everybody's so confused, so uncertain that they just have some random thoughts about the inventory management. So there is something lacking in that section. So these are the number of days. I can round them off because it's a good idea. So okay. Oh, sorry. All right. So now they used to maintain the inventory for 47 days in 2020, but in 21 they have to increase. I mean, this is a big thing. I mean, certainly the number of days inventory requirement increased by 12 days. I can imagine 1, 2, 3, 4 days, but 12 is a big number. It's almost 25% increase. So yeah. This I will not tell you now, but I can put in the red. Ideally, you would like these number of days lesser, as you said. Sorry?
They increased their operation in the rest of the
No, yeah, but yeah, but then we see from the inventory turnover ratio that the number of times they are, they're processing their inventory from the raw form to the final form of the product, which goes to the retail store. That ratio has gone down, actually. Remember, our numerator is cost of goods sold, not just cost of production. So that also include the product is ready, and now the product is demanded by some store or some outlets, and now it's transported there. So that include the demand factor also. So cost of goods sold is implicitly including the demand of your products as well.
The 2020, the company was in recession. Number 47.
Yeah. Yeah. No, you're right. Now you're giving it. This is called This is called inference and interpretation. So now you can give them some discount to the company that maybe it's not a good comparison because 2020 was a awful year. If we have the data of 19, 18, 17, 16, 15, and we exclude the year 2020, right? Then the comparison is more objective. Because we use a phrase in research called outlier. So 2020 could be an outlier. So it's not a good comparison, right? So here we go. So that's what I want from you, that you are able to make a good, you draw the good arguments. The next ratio is also very interesting. It's called accounts receivable turnover ratio. Tell me something. You make a sales to the customers. The customers take the credit from you. You give them credit because it's a norm. And you're very happy, apparently. But given the choice, would you like to give, if you have a choice that the customer, all else being equal, ceteris paribus, would you like to sell now and get the money now? Or would you like to sell now and get the money after 3 months? As soon as possible. So the accounts receivable or bills receivable or trade receivable ratio shows how many times in a year or in a certain span of time, your accounts receivable basically pay you in a given time. And you want to pay them, see what? If you give them, if you make a sales now and they give you payment in 1 month time, it means your accounts receivable turnover ratio is faster. If they pay you in 3 months, 4 months, 5 months, it means they pay you less number of times in a year. So even if you have to give them a credit, you want to give them the credit for the shorter period rather than the longer period, right? So it means that you want to have this ratio as high as possible. So here you will see that sales revenue, the total revenue, same thing, divide by the accounts receivable. It comes to be 9.42, approximately 9.5. So we can say that when you make a sales to the credit sales, then in a year, the customer pay you 9.5 times, basically. So you have to wait. And you want this ratio to be larger. You say, for the same amount of sales, the customer is paying you 9.5 times. More number of times they pay you, happier you are. But if they pay you less number of times, then your money is stuck. You have to arrange more current finance debt. You also have to make, and this will also affect your dealing with the supplier also. If your customer is not paying you faster, then you can't pay faster to the supplier as well. And the many discounts, many other, the benefits which supplier otherwise would have given you will not give you because you don't pay him faster. Well, you can't pay him faster because your customer is not paying you faster. Ideally, it's a very selfish way of thinking, but in business, it's okay. You want that your customer pay you faster, but you pay as late as possible to the supplier. I mean, you want to get more credit, but you want to give less credit to the customers. Yeah, makes sense? So now what we do the same thing for our lovely BP. We have the total sales revenue, but we don't have the information about the accounts receivable. But no problem, we can go to the balance sheet and we can see accounts receivable. Again, most likely they would be in the current assets because generally the customer pay you within a year. But if some cases, it could be that they take longer, especially in the B2B kind, business to business transactions. And we see here, we have the trade and the receivables here, but we also have the trade. We have the current, do we have in the non-current assets also? Oh, yes, we have actually. We have two figures. We have two figures now. We have the trade and the receivable. So there are some receivables. There are some customers of BP who take more than a year to pay you. Can you do a favor to me, any one of you? Can you quickly calculate on a piece of paper 922 plus 27139? 27139. So 27139 plus 922, that makes it 11, 6, 10. So 28061 is the trade receivable figure. Trade receivables figure in 21, 28061. And in the previous year, it was 840. And if you go down to 17948, 17948. So it's 18788. So we have 18788. And the formula says that it is the sales revenue divided by the accounts receivables. Yeah, okay, all good. So the formula says sales revenue, or the total sales, same thing, divided by the accounts receivable. Now we have, and we call them as trade, the accounts receivable turnover ratio. So I can call it ARTR, accounts receivable turnover ratio. And this is the sales revenue, which is here. Oh yeah, it's here. And we divide by receivables. Yeah, nothing much has changed. The customer of British Petroleum, who you sell products on credit, they used to pay you 5.8 times in the previous years, and approximately it's like 5.9 times now. So there's no real change occurred, right? Tell me something. When you make a sale on credit, you have to have a waiting period, right? So you have to wait. So how many days you have to wait before the customer pays you the money back? And that ratio is called accounts receivable days in hand. Basically, how many days you have to wait before your customer pay you. Right? You want them shorter days or longer days? Shorter days, okay. So it means that here, the customer, in this fictitious company's case, the customer, you have to wait, the seller has to wait 39 days before the customer would pay you. And now we do the same thing here. So we can call it accounts receivable days in hand. So accounts receivables days. And we can divide 365 days by the ratio. And we can say that so approximately now you have to wait for 62 days. Last year you were waiting for 63 days. So something better has happened. Now your waiting period has gone down by 1 year. And I can also put in the red. And by the same rationale, I think I explained already to you, the opposite of trade receivable is trade payables. This is the money which you owe to your supplier. And the question is that how many times in a year you pay them. But to get this information, you need something more. You need cost of goods sold you have, but you need the figure of accounts payables. And because accounts payable is a liability, it should be in the balance sheet, most likely in the current assets usually, but it could be in the non-current assets also, because sometimes you paid to the supplier beyond a year. So let's check in the liabilities. We have the current liabilities and trade payables are in the current, but are trade payables in the no. So basically your trade payables, we don't see the other payables, that is something else, miscellaneous. We only focus on the trade or the bills payables, which is more about which involve customers, if it is receivable, and the supplier, if it is payables. And we have 52611. So the accounts payables or trade payables, doesn't matter. Accounts payables. Payables. Well, we have them. Why I'm writing it again? Okay, we have 52611, 52611, and we have 360143, 6814. I want to keep them in black. I don't want to mix up black and white. Yeah, and the formula is the formula is that the cost of goods sold divided by accounts payables, and it comes to be 11 times. It means that you pay 11 times to your supplier in a year, basically. And as you said that on a selfish note, we want to pay, oh, I have the battery and I never used it. And now it's giving me warning signal. Sorry. Maybe I lack caffeine. It's called caffeine deficiency syndrome. When you don't have enough coffee and you are not fully yourself. So yeah, so the company is paying 11 times in a year. Ideally or selfishly, you should pay them less number of times. Let's see what BP is doing. We have cost of goods sold. So we can say, yeah, so we can call this ratio as APTR, accounts payable turnover ratio. And this is equal to cost of goods sold divided by the trade payables. So this is cost of goods sold divided by the trade payables. And yeah, so in a way, you used to pay 3 times a year, let's say 4 times a year to your supplier, but now you pay, let's say, 3 times a year. Good or bad? Good, because now you pay less number of times. And the thing is that how many days your supplier has to wait before you make the payment. And that would be called accounts payable days in hand. How many days you make your supplier to wait? And that is again simple. We divide 365 by the ratio, the accounts payable turnover ratio. And here we go. In the last year, you are making your supplier wait for 100 days approximately. And now you are making him wait or her wait about 131 days. So basically, you have declined your speed of payment to them. Now, you remember that there are certain ratios when it comes to the days. I put them in the red. There's a reason for it, because I want to find a ratio, not a ratio, but indicator called cash cycle. Cash cycle means if I want to make some kind of estimate that how many days cash I must have in my current account so that I can finance my future activities. That is called cash cycle. You see what, when you are running the business today you go to the factory, office, you want to make an estimate. Do I have enough bank account balance for the next certain number of days that I run my show smoothly, right? That point comes now. And what we do here, we calculate cash cycle by the number of accounts receivable days plus the inventory days minus the accounts payable days. More plus means bad for you, because then you have to maintain more. Your cash will be stuck for, so you can't use that cash for any innovation purpose or any other development purpose. This money is stuck because you, at any point of time, you have to have enough bank balance for a certain number of days to run your show smoothly. Otherwise, you can be in the crisis, and that crisis is called liquidity crisis. So to maintain your liquidity position, ideally, you would like to have lesser number of days so that you can assure yourself. Historically, in the past, we have been running the show by maintaining 30 days cash in our bank and things going well, but now things have become troublesome, and now we have to maintain cash for a larger number of days because you never know, things can go out of hand. So larger number of days in the cash cycle is a bad indicator. It means now you have to go run the show more smoothly, more cautiously. But less number of days means you can easily run the show without worrying too much about your current bank account, because things are going well, no problem. And this is why you want to have less number of accounts receivable days, you want to have less number of inventory days, but you want to have more number of accounts payable days. So what we do now, we simply have our inventory days in hand, 59, plus we have accounts receivable days, and minus we have the accounts payable days, and it comes to negative days. But that's interesting. That's very interesting that we got a negative figure. Focus on number of days, 9. Now 9 days means in 2020, in the year 2020, on 21st January, BP must ensure that it has enough cash resources until 30th of January. And then we check the same thing on 22nd of January, that BP have enough money for 31st of January. And now this year, things have become so good that even we have more money than we required in our cash balance. So basically, even if we make it zero, even if we spend money, we have some money, some X amount of money in our current account, if we spend that money elsewhere, nothing wrong will happen. So basically, we have more money in our current account than we need it. But if the days are increasing from 9 to 19, that's a bad sign. Negative is fantastic. I mean, even if the BP is spending money on some other activities and this becomes zero, it's fine, no problem. Even if it is 1, 2, 3 positive, doesn't matter. It's still an improvement as long as it is 9 or below 9. But if it is 9 and this is 20 or 19 or 15 or more than 9, then it's a sign of inefficiency. Negative means basically what lesson we learn from 9 and 10 is that BP, despite all the odds, the market is still struggling. We're still in, well, earlier it was COVID and now it's a war going on next door in Europe, and there's a lot of unemployment. The interest rates are going up. The macroeconomic indicators are not very positive. But in 21, BP has one very good success, and that is they were very liquid. I mean, their cash situation was so good looking. Good for BP. All right, makes sense. So this is why I was on purpose, I was writing these certain indicators in red, and I can save this file. And I can share it with you at some stage. What should we call it? Operating ratios or some BP, BP basic ratios calculation, basic ratios calculations. But this is not replacing BP2 file, which I have in Moodle. That's far more comprehensive, very in-depth. And I don't want to indoctrinate your minds, but in the heart of my heart, I would expect that you do the same way. The graphics, the visuals and everything. Yeah. Okay, I can save it. Strategic information accounting. And I would share it with you later on. Maybe before I start next set of ratios, we take a break, lunch break, basically. Yeah, is it okay? You have food now, or you? Yeah, all right. Okay. So, Alexander, we take a lunch break now, and then we join after the break.
Okay.
It's 11:17, right? Should we resume at noon? Because then we'll have net 2 hours to do a lot of things. So then we go in the one shot. All right, see you at noon and have a nice lunch. I hope they serve you good food.